This is Gavin Sirkin for Frontera TV. Joining me is Kieran Curtis, who is the Investment Director for Standard Life here in London. Kieran, thanks very much for joining us. So I want to ask you first of all about emerging market currencies, because we've seen quite a rebound over the most recent period, but before then we saw the valuations deteriorating to the lowest in 5 years, the cheapest level based on the real effective exchange rate, stripping out the price movements. Where do you see the opportunities now?
Well, thanks for having me, Gavin. I think it's probably wise for investors to take something of a pause for breath. I mean, as we said in a note back in the earlier part of the year, EM currencies certainly had some room and probably have some room to rally. They became quite cheap on many measures, not the cheapest ever, but not too far off. And we didn't think that was quite justified by the direction of fundamentals in emerging markets. But equally, we haven't really seen a strong return to growth from EM. And in order to deliver the kind of returns that we've had over the past 6 weeks for a sustained period of time, then we do need to see a return to strong fundamentals. And as yet, we haven't quite seen it. So we would probably recommend that investors just temper their enthusiasm somewhat, while reminding them that there are some absolutely fantastic opportunities and still some places where there are great returns to be had. So perhaps starting with one which is one of our favourites at the moment, in Peru, we've had a real change that we think has been underappreciated by markets, where Peru has invested a lot in the mining sector, and as that began those investments began to complete, then growth slowed, but upon completion, then production at these mines has really begun to pick up very, very strongly, and will actually almost double by the end of next year from the level in, say, September 2015. So we're seeing very, very strong growth in a commodity which is exported. Export growth has been quite hard to come by in emerging markets in recent years because trade volumes have been low. And we think that investors will want to get exposure to Peru and to the currency, and they'll find that bond yields at say 7% or a bit lower than that now are really very, very attractive for an economy with a track record of very low inflation.
Okay, we're staying in Latin America. Of course, we had the enormous Argentine bond sale, raising $16.5 billion, getting orders for $70 billion. Were you one of those placing the orders?
Actually, in the end, after much consideration, we decided not to participate in that deal, largely because we just felt it was too expensive. The level of enthusiasm clearly enabled the Republic to take advantage and issue at what we think are quite cheap levels, and certainly compared to similarly rated peers, or at least on expected ratings, for what other countries can borrow at in similar situations. I guess we were also slightly disappointed by the level of detail we got from the Republic about the plans for cutting the fiscal deficit, which had grown very, very large under the previous government, and for getting inflation down. And clearly inflation has been one of the serious issues facing Argentina for a great many years, even before the fiscal deficit became so large.
But on that, I mean, you have seen Macri taking quite stringent steps to cut, for example, the energy subsidies. What more were you looking for there?
Well, I think what's happened so far on subsidies has actually been probably smaller than is really required. But also, taxes will need to go up. And on balance, Macri's probably cut taxes. I mean, some of those tax cuts have been very sensible. Lots of them have been tax cuts on the export sector, which has enabled exports actually to restart. And that in itself will probably deliver a bit of a boost to the economy. But there really hasn't been any major source of new revenues. and yet wage negotiations continue really, I think, to go in the favour of the employee rather than the employer as the state. So, for instance, the two sectors of the economy, transport workers and teachers, where there's a big public sector involvement clearly in both. Those wage negotiations have been settled since Macri's victory, and they've been at plus 40% year on year. So still, very strong growth in the expenditure side of some of those lines in the government budget, and clearly again an indication that inflation expectations are very high.
Okay, so Macri is having, apart from you, maybe quite a honeymoon with other investors right now. One president who's not having such a great time is Dilma Rousseff right now. What's your perception on Brazil? How are you fixed in terms of holdings there?
We think Brazil has really very good creditworthiness from an external perspective, a huge amount of dollars in reserve, far more than, IMF benchmarks for how much emerging market countries should hold. They also have quite a professional central bank. The governor has maybe been a little involved in the political process in recent years. But clearly investors are expecting some of those key individuals to change after the impeachment process proceeds. And we do think that that's very likely, that the impeachment process proceeds further. Again, as with Argentina, we're likely to see the economic team being full of names that are familiar to investors. The Vice President has been suggesting names to the market effectively. And by and large, the market is quite happy with what they've heard through those channels. But again, we think that the real political work of cutting spending is going to be something that will be quite difficult for him to do. He's not a popular politician. His poll rating for the 2018 election is somewhere around 2%. And his power will really rest on the commitment of coalition partners. Some of those coalition partners will want to run for president themselves in 2018, and also the opposition will probably be quite a bit stronger than it's managed to be in recent years with the PT in power, because the PT are undoubtedly Brazil's most effective party of opposition. Being rooted in the labour union movement, then they know how to get people onto the streets to protest against things like pension cuts, which is certainly how they will try to present the pension reform and social security reform that is going to have to be at the heart of any Temer economic plan.
Okay, Kieran, staying on the big economies in emerging markets, China, the biggest of the emerging markets. It's a massive economy. How do you begin to dissect that and pull that apart? Because there's lots of different regions, lots of different provinces, and within the bond market, it's very split up between corporate debt, for example, and government debt. What do you like? What don't you like?
Certainly. Well, in the government bond market, then there's really not very much for overseas investors to do at the moment. It's very difficult to buy the onshore debt, and offshore government debt, direct government debt, really doesn't exist. So it may change this year. In fact, some reforms have been announced that will really open up the domestic bond market to foreigners, but no one is still precisely sure exactly how the details are going to work, but that could present something which is very exciting for investors, especially as yields have been rising lately. Then on the corporate side, there's really a split between state-owned enterprises, which are often quite inefficient beasts, not always, but they often are. But they're also often very expensive bonds to hold, because they're assumed to have the backing of the government, and the government is assumed to be a very credit-worthy entity, so spreads are extremely tight. we've typically been quite underweight China as a result. I mean, we do believe that the economy is slowing, and many of the issuers come from the older side of the economy, which is slowing faster than the newer bits of the economy and services, for instance. So we haven't felt like they've given us enough. But there are some interesting opportunities out there. One has been certainly in the property sector, where there have been two dynamics recently that have made some of these bonds very interesting. So one of those dynamics has been the recovery of prices onshore, and the recovery of, more importantly, sales volumes onshore, which have given developers the cash flow in order to service their debt. But the other was some reforms which opened up the domestic bond market to these companies, which coincided with very high levels of liquidity in the domestic market. And that's enabled lots of these companies to issue bonds onshore in China at yields way, way below where they could hope to issue offshore.
Well, what are we talking about? What sort of levels?
Well, probably 5-6% compared to maybe 8, 9, 10% in the offshore market. So some of these companies have been interested in buying back their offshore debt funded by domestic issuance, and others are just using domestic issuance for what borrowing requirements they have, and so not issuing further in the offshore market. And this has presented quite an interesting technical, while also giving comfort to bondholders that they know where the refinancing is coming from for these companies.
Okay, one country that's been in the focus a lot because of the immigration crisis for Europe has been Turkey, which has on the one hand been talking a lot with the European Union, on the other hand has been a big part of the Middle East tensions. How do you see Turkey at the moment? What's your outlook and how are you positioned there?
We're quite underweight Turkey. I think the ebb and flow of the migrant crisis and the talks with the EU have both positive and negative points for Turkey. Clearly, if there is a real re-engagement with the EU, then that's seen as being very positive. One thing that stands in the way currently is still the Cyprus question, but there are real hopes that a deal can be agreed on Cyprus this year. Talks are probably taking a bit longer than were hoped at the end of last year, but they're still ongoing and in good faith. So that could be a real positive. But there's a structural issue that concerns us about Turkey, and that's been the level of credit extension to private companies. And some of those companies have been related to the government budget for infrastructure projects, but that's actually by no means an enormous extent of what's been going on. But the savings that have funded that investment by private companies have really all come from overseas, and the facilitated by the local banking system. The local banks have generally borrowed abroad, and they've been at quite short tenors, and this leaves those banks probably more vulnerable than any others to changes in funding conditions in the offshore market, and it makes, say, Federal Reserve policy meetings much more important when considering a view on Turkey than in most other emerging markets.
Thank you, Kieran. It's been an interesting trip around the world. So, Kieran Curtis, Investment Director from Standard Life, has been our guest on Frontera TV today. I'm Gavin Sirkin. Thank you very much.
Thanks, Gavin.